Hello, everyone. Thank you for joining us today with Ignite's Innovation webinar series. I'm excited to moderate this amazing panel of experts to discuss how to engage an investor in this new world. As everyone's aware, the world has changed significantly over the last year. It's very different than it was a year ago. We've all had to kind of change our strategies in regards to how to deal with our new norm. Therefore, we thought it was important to bring together this group of panel and talk about and bring those topics to the forefront of how to assist investors and entrepreneurs to navigate these new times. My name is Chantel Preston. I am the co-founder and CEO of Facilities Management Group here in Houston, as well as I'm also a lead partner for the Portfolio Active Aging and Longevity Fund. I'd like to go through and introduce the panelists, and then we're going to jump into questions. What we do today was take the questions that you guys had provided us during registration. We're going to try to hit as many as we can to make this effective use of your time. So first of all, let's go through and introduce the panelists. Kyra, you want to go first?
Sure, yeah. My name is Kira Doolin. I am with the Texas Halo Fund, and I am one of 4 managing directors at the Texas Halo Fund. So we started in 2012 with our first fund, and I came on, I think it was about 2.5 years ago, with our second fund. And since then we've raised a third fund, and we're actually in the process of raising our Texas Halo Fund 4. And what we do is we are an early stage investment fund. So we get in at sort of the angel round, but we pool angel investors' money and then invest as our group into startups. We are a diversified fund, so we invest across all different kinds of sectors. We're definitely heavy in life sciences, being in Houston, so we're probably in any of our portfolios about 40% life science. But we also have consumer products, we have software plays, tech deals, so really anything. And even though we're all based here in Houston, we are nationally investing. So we've got deals on the West Coast, the East Coast, Middle of America, all over the place.
Okay, wonderful. Thanks, Kara. How about Karen?
Hi, I'm Karen Carr. I am a lead partner at Portfolio's Rising America Fund and the founder of Exposition Ventures. The Portfolio Rising America Fund is focused on investing in entrepreneurs of color or entrepreneurs that are LGBTQ. We're investing across all industries and all stages. There are 5 lead partners, all women of color, and excited to be here. And this is emblematic of the new norm that we're living in. I'm indoors with other people, despite the fact that it looks like I'm outside, and so need to wear a face mask.
Thanks, Karen. Dama.
Hi, everyone. My name is Damayanti Dipayana, but most people call me Dama. I'm the CEO and co-founder of Manatee. Manatee is a behavioral health platform for families and children. And I just raised our seed round during, the beginning of this year. So during COVID and everything else that's going on. So I'm really here to give kind of an honest perspective of the founder going through early stage fundraising, and super excited to give some insights, answer questions, and all of that good stuff. So thank you for having me.
Well, Dom, I think everyone's going to be really excited to hear your story, especially the fact that you've really lived through the pandemic and having to change a few things here and there to get your deal closed. So we'll get to those questions. So let's kind of go ahead and jump in and get started. In regards to the new world, first of all, I want to kind of define what we're referencing as the new world. We all know what's transpiring in the world, especially with the pandemic, but this also pertains to also the equality aspect. And so we're going to cover a lot of those as we go through these questions today. But first of all, let's kind of take a step back and simplify. Kyra and Karen, I kind of want to talk a little bit about the difference between angel investing versus venture capital. You kind of explained it a little bit in regards to how you guys, look at deals and the deals that you're currently in, but let's go ahead and give a better, more detailed explanation for those on the call as to the difference between the angel versus venture. So Kyra, you want to start?
Sure. So I think, for me at least, angel investing would be at an earlier stage typically than venture capital. So angel investors traditionally are individuals with money who are looking to invest in startups. They can be part of angel groups. So in Houston, I think we have the most active one in the United States, the Houston Angel Network, which is a group of angel investors together. And angel investors, I would say, generally are putting maybe $25,000 and up into each deal. So you're looking at smaller raises for that. Venture capital typically comes in a little bit further when you've proven your concept. Maybe you've got some sales, you're a little bit further on with your company. And they write on average, I think, somewhere around a $7 million check. So that's a much bigger round. Angel investing rounds, I would say typically we're seeing something between maybe $500,000 upwards of 1.5, maybe 2 million at the high end of angel investing. And typically companies have maybe had a friends and family round before they're approaching angels, and this is their first investment that's not from people that they directly know. Halo Fund is sort of somewhere in the middle where we are getting in at that angel stage, but we are not investing with our own money, we're investing with our investors' money. All of us managing directors are invested in the fund, but we're not directly investing. So we're kind of a hybrid model where we're getting in with a seed stage or the earlier raises, but we're doing it more of a fund structure, if that helps.
Absolutely. And Karen, what about on the VC side?
You know, I would say, I mean, I think Kyra's definitions are good. I'm not sure there's as bright a line. I think angel investing has become a lot more professionalized. And I know I participate in an angel network in Chicago where I'm based. And, you know, we've in our network done $3 million plus rounds that our angel group is committing along with other groups. So I think you're certainly seeing angel groups move upstream in terms of what they're looking for. And at the same time, I think you're seeing some of the early stage groups have very active seed programs where they're investing behind angels that they know. And maybe there aren't, and it's a way for them to get a toehold and see what's happening. In general, I mean, so in addition to this sort of stage and size, I also think there's a little bit of a difference in terms of the vehicle that gets leveraged in the angel rounds. You tend to see a lot of these safe type agreements, simple agreements for equity where perhaps you don't price the round, you're coming in at a discount. Whereas, you know, in the VC world, they're much more accustomed to pricing the round and leading the round.
Okay,
I
great.
had one thing, just because I obviously like these are super appropriate definitions, but just to give the audience a view of like what our round looked like. So we put together a syndicate, and for me, actually, it was really important. So we had a priced round, institutional money, but I knew about close to 10 angels that were really strategic to us that I really wanted to have to be part of the round. So we had institutional money accounting for, say, 1.3 million, 1.2 million, and then the remainder was reserved for strategic angels for us, knowing that also angels can be incredibly helpful, you know, just to move everything else forward. So for us, it was like healthcare operators, people who had run like Blue Cross Blue Shield groups, all of those things. So it's not necessarily mutually exclusive is what I'm trying to say. And there is a blurred line, and it's just thinking about what works best for your company, depending on where you are.
And Dama, when you started this, where you ended up versus where you anticipated on up front, was it different from what you initially thought you were going to get versus at the end what you ended up with?
I mean, it was a little bit of a roller coaster for sure. So I think we went in kind of before the pandemic really hit, like super optimistic. We had it all planned out. You know, we really managed kind of our investor pipeline super well, so many warm leads. And we went out like, okay, now we're ready to fundraise. So we went out actually with like a higher valuation. We wanted to raise more money. And then all of a sudden, everything got shut down. And, you know, you have to anticipate. I mean, I don't think, well, we may get a lot of those scenarios moving forward, but it just wasn't something that we anticipated. And I don't think that any of our investors anticipated this either. So you do kind of have to roll with the punches. So I know that we'll talk more about it, so I won't ramble on, but I think we really thought about, okay, can we raise less? Can we extend our runway? Like, how can we think about this strategically? Like, what's the most important for investors right now? And thinking also about like, okay, looking at the end of, you know, potentially an economic downturn and the pandemic, like how can we get there and still achieve the milestones that we need to achieve, and just be creative around it, because you can't, you know, go in full throttle pretending that it hasn't affected investors or our company.
Absolutely. And that's a great parlay into my next question. And I would love to hear from Kyra and Karen in regards to how your mindset has changed. How has your mindset changed today versus where you were a year ago? And in regards to your investments, the types of investments, the timing, the milestones that you know expect them to achieve. How has that mindset changed with everything that's going on in the world today? So Kyra, how have you guys looked at things different today versus a year ago?
You know, I think our fundamental investment strategy hasn't changed. We're looking for great companies that have a market, that have an innovative solution or product, and that have the teams that can deliver it. So as far as that goes, that's the same as it's always been. We're not looking at, you know, companies that are specific to trying to solve COVID or something like that. We're staying pretty much true to what we already do. I'd say the first thing that we did when all of this started was really start looking at our existing portfolio. And I think probably most groups did that to kind of see where they were at. So we started looking at all of the companies that we had in our portfolio, looking at when they had done their last raises, how much cash they had in the bank, and how we thought this pandemic would affect them. We've had some portfolio companies that have done incredibly well because of COVID. And we've had others that, you know, it's slowed things down for them, or it's created problems that would never have been there had this not happened. So we started there. I'd say when evaluating new opportunities, Dama mentioned a lot of this really well. I think you have to really look at if they're being reasonable as far as the economic situation that we find ourselves in. And what that looks like is, you know, we're seeing lower valuations maybe than we would have before this, because the effects of this are going to go on for a long time, I would guess. Even when COVID sort of starts to come down, the economic downturn, that's going to still exist. So we're looking to see kind of what valuations are and that they're reasonable. We're seeing a lot of companies that are opening up past rounds. We're seeing bridge rounds. We're seeing, you know, companies in our portfolio who are going to do bigger rounds, who are taking it down and raising less money because that's just what's going to get them where they need to get right now. And I think when we're talking to new companies, it's important that the companies be upfront about the problems that they're facing. We all know that these problems exist. And of course, that varies a lot, whether you're a healthcare company or a consumer product. It all kind of is very different what those problems will look like. But I think addressing that head on with investors is a good way to go, because having trust in a company that you're investing in is really important. And then I think we're also looking to see that the companies are being nimble, that they're being creative, that they're cutting costs where they can, that they're getting ahead of the issue rather than kind of just responding to it. We've made investments in new companies since this has happened. And I'd say what's been appealing about them is the way that they've approached the situation. And we had one company that cut salaries 20% across the board because they just knew they needed to cut costs. And the founder actually took her salary down even beyond that. So I think leading by example is another good one. And we're making sure that whoever we're investing in has enough money in the bank to make it at least 6 months, hopefully more like a year.
And that's interesting you brought that up. I've heard that as well. It seems like a lot of the VCs or a lot of the investors at this point are looking at your cash reserves and making sure that you don't just have, you know, a couple months, that you've got 6 to 12 months to be able to kind of ride this roller coaster, because there are so many unknowns of what's going to happen in the next 6 months. So that's interesting. I have heard that as well in regards to what they're looking at in regards to cash reserves for companies. Karen, you know, obviously with your involvement with Portfolio and the Rising America, you know, your focus is people of color, LBGT. So you're really looking at the equality aspect of investing. Kind of talk to us a little bit about, has this changed your, you know, perspective on what you're looking for to invest in? Talk about, you know, what you're seeing out there and the opportunities that exist because of obviously the spotlight being put on the equality aspect.
Yeah, and I like Kyra. I don't think the fundamentals have changed. I think the investment thesis and philosophy is still the same. It's gratifying to see a lot of groups wanting to invest behind entrepreneurs of color and LGBTQ. And we'll see how long they do that and whether they're voyeurs to it. But I think certainly we're looking not just at the entrepreneurs that fit into those categories, but I think the pandemic has certainly shown a bright light on some of the inequities that exist. And so solutions to some of these challenges are interesting things to think through as well. And so, you know, our very first investment in the Rising America Fund was a fintech company focused on the unbanked and underbanked, and that's a problem in communities of color. And we continue to look for those kinds of opportunities. And I absolutely agree that one thing that we're paying a lot of attention to is expenses. And we expect sales cycles in many of these industries to be extended, and so making sure that you have sufficient cash to get out, you know, a year is really what we're focused on as well. So I spent a lot of time thinking about that syndicate, because the syndicate you start with may be the syndicate that you're with for a while here. So that's an important thing for us as well.
Going back to something that Kyra had said in regards to pivoting, you know, obviously your thesis hasn't changed much, but you're seeing a lot of these companies that are trying to pivot to handle the specific needs right now in regards to what's going on in the market. Is that really the right way to go? Or are you still looking for the companies that, hey, let's stay focused on our core business and our milestones that we're trying to achieve? You know, I see a lot of companies, oh, I can do this now, I can do this. That's great, but what's your core competency, and is it going to get you to the next milestone or where your investors feel like they need to be? Have you seen that happen with the companies that you've invested in, or are they staying solely focused on their core mission and you know, accomplishing the milestones that they, you know, created a year ago?
Early stage companies are often looking for a product market fit and doing a little bit of pivoting. I think the ones that are going to be truly successful are ones that have an unfair advantage. So if you're pivoting, but you don't have any advantage, you're not going to be well served. So I would tell you that the companies that we're investing in, they had an unfair advantage in those spaces because of expertise and relationships, and they're sticking with their knittings.
Fair. And so this was a great question that came from one of the registered folks. Is the spotlight is currently on the women and people of color founders and investors. How do you feel about being characterized such as this? And I'm going to kind of throw this to Jadama. Are there upsides to the identity-based labels, or are there downsides? So what do you think in regards to what you've seen in your world?
Yeah, I have a lot of really strong feelings about this. So I will also preface this with, I think this is very personal. So, you know, how I feel about this may not at all be reflective of what the audience or how the audience or how you individually feel like this. But I personally, and I talked a lot with this with other founders who are qualified as people of color, or but I personally feel like a fraud, and I'll tell you why. Because I think a lot of like what we're really trying to address here is equality of opportunity, right? I am from Europe. I've had all of the privileges that come with being traditionally male or Western. I've been to private schools, so I always make a joke that I'm like the person of color and the female that the status quo feels really comfortable with, meaning I'm like the gateway drug to equality. And like that makes me feel really uncomfortable. So I personally try to stay away from, you know, events or access to funding for people of color, because I feel there's so many other people that are much better served for those opportunities. Now, I would also therefore argue like other larger corporations, you know, really evaluate whether you're driving equality or whether you're just making yourself feel good. So that's my perspective. Let me see, there's one. And also like, there's a part of me that's like, we're not even close to equality if we need to have a qualifier for people of color or women that are successful, right? Like, why can't you just be a founder? Why can't you just be an entrepreneur? Why can't you just be a CEO? If we have to qualify that they're Black or they're female, like, we clearly have a long way to go. So those are the downsides, and I'll put them in a bucket. The upside is, I think it's really amazing that there's a spotlight on it and that the press loves to talk about it and loves to push that narrative, because at the end of the day, if that means that, our younger generations have examples and pathways that they can latch onto, that they can look at, that they can see those opportunities, then that's a really amazing thing. So I'm totally fine with the label in that sense. And I certainly will push it forward, but I also feel very strongly about the downsides. But that's me personally. So that's how I feel about it.
Karen, Kyra, any comments on that?
I'll take that one. I mean, I think, Dama's experiences are certainly her experiences. I think it's great that there's the attention. I will say that there's also the downside of it is when there's like, it's a quota based thing, folks are always going, well, you only got it because. Right. And I didn't get anything in life because I'm a Black woman. I got it because I was good. Or there's a sense that I'm going to do it but I'm not expecting great returns, or I'm expecting to lose money. No, I think and I think the data bears this out, that in investing in diverse communities and in diverse entrepreneurial teams, that actually they're driving really great outcomes. So that's the potential opportunities are positive, but sometimes it does drive some unconscious biases and perspectives that we just maybe need to make conscious and realize that they're not actually accurate.
Well, let's go into the specifics in regards to evaluating an investment. I know we have a lot of entrepreneurs on here as well as investors. So let's talk through a little bit about what's important to you when you're looking at whether a company fits within your thesis. And Kyra, I'm going to start with you. Again, we might be repeating, but I want to go into a little bit more detail. So when you're looking and evaluating a company, what are the important things that you look for in that organization, but also what are some of the red flags?
Yeah, I'd say the first thing to say is, especially now, as an investor, we're getting inbounded by startups and by companies nonstop. So I think when you are trying to get in front of an investor before you've even started talking to them, you have to understand that a lot of these people who are trying to get in touch with me, I'm not even reading the emails because, it's saying, dear whoever it may concern, or dear sir, or dear somebody else. I think the first thing that you need to do is try to really understand our fund, or whichever fund that you're trying to go after, whatever investor you're trying to go after, and pitch them in a way that's personal to them. Because again, we're getting 10, 20 deals every single day coming in. So you have to stand out from the beginning. Once you do get in front of those investors, I think for us, the most important things are, we're looking for a strong team. And that doesn't mean that you have to have done it before. I think a strong team is one that can deliver the product, the service, the solution, whatever it is that your company is delivering, and knows where they're lacking. And that's okay if you're lacking in something. So you could say, we don't have sales experience in a year down the road when we're really pushing out. These are our ways of trying to handle that. So it doesn't mean that you have to have the perfect team in place now. It just means you have to have the team in place that can get you to the next milestone and knows how to fill the gaps. And then I think we're looking for innovative solutions, and we're really looking to see, does the market want this? And is there a large enough market for it that we're going to be able to see the returns that we're looking for on our investment? And at our stage, what we're looking for is any company that we add into the portfolio, and this is generally the case with angel stage, can generate at least a 10x return on our investment. So, that doesn't necessarily mean that happens. Some of them will fail. Some of them will do exceedingly well. We hope some do even better than 10x, but that has to be there in order for us to be looking at the opportunity. And then I think we're also looking at the terms of the deal. And especially now, that means that you need to be appealing. You can't have a valuation that's knocking it out of the park right now, because we're seeing so many deals and those valuations are starting to come down. So if we see a valuation that's just far out of what we think is reasonable, we're not going to look any further than that. And for us, we're typically between about a $3 million valuation up to about $10 million valuation. So just as our fund, anything beyond that is typically too far along for where we invest. Yeah, those are the important things. I'd say red flags. If you say you have no competition, that's a red flag. Everybody has some sort of competition. I'd say that projections, financial projections that are just completely out of the ballpark. You know, we're looking for you to be optimistic, but we also want you to be reasonable. What else? Thinking that, you know, I think entrepreneurs who seem like they think they know everything can be a challenge. And I think we like to work with founders, and we're very involved with the companies in our portfolio. So we're looking to work with founders who keep an open line of communication, who seem like they would be good to work with, who seem like they would be a good fit for what we're doing. So I think if they seem like that's not the case, then that's a bit of a red flag for us as well. And then I think with regards to the current situation, if they're not addressing the fact that COVID is going to be some sort of problem for them, which most of the time it is, some it's an opportunity, but if they're not willing to be upfront about that when they pitch us the first time, I think that can be a bit of a red flag as well. And then again, not having enough money in the bank, especially right now. You know, if you have a month's runway, 2 months runway, and you can't tell me how you have the commitments to get beyond that, we're not going to invest money if we don't think you're going to be viable as a company, or we don't think you're going to be able to hit those next milestones.
It's interesting. I mentor a lot of startups, and it's amazing to me because I like to call it dumb money versus smart money. You know, you can always usually find an investment if you look hard enough. However, what value is that investor bringing back to you? And I think that's so important for entrepreneurs, especially in very early stages. Like you said, being coachable, being able to have that conversation and extend, you know, your expertise to them or your experience. I think that's so critical, and I think that's missed by a lot of entrepreneurs because they just see big money, you know. I'm going to go to the VC world. I'm going to go to Karen here in a second, but it is a little bit of a different of having folks that are actively involved in helping you, you know, hit your milestones versus someone that's just giving you money and just sitting back and waiting. I think it's very important to weigh what's the better for your company as you grow.
Yeah, and I'd say to that point, we're on the board as a board member, a board observer of a lot of our companies. We try to syndicate fundraising. So if we're putting money in a deal, we're reaching out to everyone we know who we think would be good for that deal as well. So again, yes, I think finding an investor who can bring something to the table for you besides just money is crucial. And my 3 fellow managing directors, we all have very diverse and different backgrounds. And so we bring that to the deals that we have in our portfolio. I think that's a great point.
Wonderful. Karen, what about you on your side?
Again, I think it sounds pretty similar. Obviously, we're looking with fit with the thesis. That's very important. I'm looking for great entrepreneurs that are high integrity people. I'm looking to see that they really understand the industries that they're in, and I really spend a lot of time understanding how they think and how they've gone about building their team. And their team can be actual team members, or their team can be advisors and board members and the like. I think that says a lot about the person. It does speak to some of the elements of coachability. And I'm trying to understand what their unfair advantage is. And I spent a lot of time just thinking about, you know, what are the comps? You know, how large is this market? What are the dynamics? How easy is it to penetrate? All projections are fantasy, but it is helpful to understand how they think about it. And that says a lot to me about whether they understand that industry, what their go-to-market strategies are. I spent a lot of time on that. So that's generally what we're looking for. But we spend a lot of time trying to get to know the entrepreneur.
And that's great. I'm gonna throw it over to Dama because you are the entrepreneur. So talk to us a little bit, since building a team is such an important component to an investor. Talk to us a little bit about how you built your team, you know, from the beginning to now, and how you were able to find the right folks, but also find the right advisors. As Karen mentioned, the right folks to help guide you along the way. Give us some insight about how you built that with your organization.
Yeah. So I think So there's two components that I think is really important for any entrepreneur to have, right? Like you have to have this art of persuasion. Like you have this dream and this vision, and there may not be anything there yet, but you need to be able to take people on this journey with you. So they're like, yes, I can see what this future is going to be like. And that's how you get really compelling advisors. The other part is you really have to know yourself as well. And that, as painful as it may be, but you have to understand, like, this is where I'm really good and this is where I'm just not that good. And, you know, no one's perfect. And I think, so when I think about how I build my team, like I look at, okay, what are really my blind spots here, both from a skill set perspective, just executionally. Like I am not gonna, like, we're a tech company, like, unfortunately, I'm really, really, really bad at coding. So I will have to find like a really amazing engineer. So my co-founder and like the foundational team, I felt, you know, if I have a badass engineer and me on the commercial side, we'll be fine building the foundation. Now, the other skill sets and where I felt that could add clinical, because we're in healthcare and also neither of us, we have a real strong personal connection and experience with the problem. Like we're both parents, my co-founder and I. Like I grew up with a bunch of behavioral health and mental health issues in my family. Like his wife is a clinical psychologist. So we had a lot of really strong personal connections to the problem, but we're not clinical experts, right? So the next step for me was, okay, I can build a platform, but how do I know that I'm building the right platform? And that's where I really thought about, how do I draw in additional credibility and expertise? And that's when, so when I looked at our advisors, and going a little bit back to Karen's point on an unfair advantage, I unfairly had a lot of relationships in healthcare. So I could pull in really amazing, you know, Harvard experts on pediatric psychology, you know, people who studied stress responses in children. Like I had those people in the network, and then that persuasion piece comes in. You're really just selling the dream. Obviously, like you're selling the dream, there needs to be reality in the dream and some execution power behind it. But you really then have to figure out like what's in it for them, because you are asking time and resources from people that generally are, you know, have other stuff to do. So how do you make it really compelling to them? So yeah, those were like some of the things that I looked at. I was like, what are the blind spots and the gaps in our business that we need to fill, and how am I going to fill this, and how do I make it compelling for the people to get on the journey? But I can imagine any investor will look at it being like, if you can't get the right people around, you can't sell it to them, like how are you going to sell it and, you know, completely uproot an industry? So it's kind of the first piece where persuasion is going to be really important.
Wonderful. And Kara, going back to your point in regards to, you see 10 to 20 new opportunities a day. So some of the questions that we got from the participants is, you know, what differentiates, or what are you looking at in their pitch deck? So when you get those pitch decks come across your desk, we all get them on a consistent basis. I'm kind of like you, I thumb through them and most of them end up in the round file. What do you look at in the pitch deck that would make something stand out over someone else? So again, you talked about personalizing it to you, but in regards to the pitch deck, what is important things for you as an investor to see that they've covered within the pitch deck?
Yeah, I think going back to the issue of time, I think having a pitch deck that's clear and concise and that very quickly gets into what you're actually doing is crucial. I've seen plenty of pitch decks, both live and just in my email, where I've gone through 10 slides and I have no idea what the company does. That's a problem because you've lost somebody already. And beyond just sending a pitch deck, when you're doing Zoom calls, I think it's even harder to keep people's attention than it is in person. So you need to be clear, you need to be concise, and you need to very quickly get into who you are, what you are doing, and why you are doing it, and why I should be interested in it. So I think those are crucial elements that happen, you know, in the first 1, 2, 3 slides, so that my attention is grabbed by that. Once you've got that, I think it's important to have an understanding of what the market size is in what you're addressing. I think it's important that you've outlaid what the competitive landscape is and why you are different. And then we're looking to see that you're protected as well, especially if you're looking at healthcare life science. So IP, you know, is it issued? Have you applied for it? Why are you going to get it? What makes this something that somebody else can't rip off tomorrow? And then, you know, our investment in you isn't worth anything anymore. timeline. So a slide that explains where you are today and where you're going to be maybe over the next 3 years, 5 years, whatever it needs to be to really get that point across. And then as an investor, I want to see the terms of the deal in the pitch deck, because if those terms don't match with what we're looking for, we don't need to go any further. And then from our point of view, we don't invest in LLCs. We only invest in C Corps. So putting that in there is important as well.
Interesting. And so Karen, talk about in today's world, getting a face-to-face meeting with potential investors is becoming more and more challenging. Everything's being done via Zoom. How do these entrepreneurs looking for investors, what's their best strategy? I mean, I know I've invested in companies without actually physically meeting the founders because of the situation that we're currently in. But talk a little bit about, what they can do to put their best foot forward in trying to, Kyra said it great, at, Zoom meetings, my attention span sometimes disappears very quickly. So how do these entrepreneurs really get in front of these investors? And have you made investments without meeting the founders? What can they do to put their best foot forward to sell it in a way that they don't have the opportunity to be face-to-face?
You know what? I never thought I would make an investment without meeting the founder face-to-face or visiting their site. Right. And I have had to do that, and I have done that recently. And I think the way that I got comfortable with it was the opportunity was referred to me. So it was a warm lead by someone I respected. The pitch deck, by the way, was lousy. So I won't even lie to you. It was terrible. But the CEO's background was perfectly matched to what the company was doing. And they had other investors that I knew and were referenceable. So to some extent, the proxy for my not being able to meet them was that we had a lot of network connections in common. And, we often say, you don't get too far throwing your pitch deck in over the transom. You got to work your way to a warm lead. And I think that's true now more than ever.
Yeah, I think that's a great point. I will always read a pitch deck if it's coming from somebody who I know and who I respect. That gets you in the door. And so if you can look at your LinkedIn and find any sort of connection you have with the person that you're trying to go after, or you can even find a secondary connection with that person, I think that definitely helps. We're getting ready to make an investment right now in a company that we've never met with, none of us have met with. And it was referred over by somebody who I also know and respect. So that's kind of how they got in.
Interesting. I've done a lot of investing. I always say follow smart money. If people have good track records of investing in companies that are successful, I usually have a tendency to listen a lot more because, again, I know what their track record is and they've probably done their due diligence. I know some of the things that we've done on our side is really depend upon those other investors for due diligence information. If we can't do it all ourselves because of what's going on, then we utilize their expertise. And it's a great collaboration to understand things that they looked at versus what we did. And it's really helped us excel our investments just because, again, not having the ability to go into their shop or go into their office and have those one-on-one conversations, getting that information in other ways. So I think that's critical right now. And I think it'll continue to be that way for a while, unfortunately. And so how, this was a great question, how can you fundraise when investors always want to see revenue, but you need the revenue or you need the investment in order to generate revenue? So what advice do you have for entrepreneurs in regard to that are pre-revenue, that are looking for investment? So talk about, what you look at in that scenario. If they don't have revenue to show growth or to show execution, what are the other components or what suggestions would you have for them on that? So Karen, talk a little bit about that.
I think in those instances, I'm generally looking for two things. One are kind of the constellation of people around you. Do I think they're going to help you be able to go get revenues? And then the other thing is if they've got some partnerships lined up or some demonstration pilot type things, even if they're not paying, if somebody can say, yes, I have a need for this. I've seen it and I've got a need for it. That's typically helpful. If we understand what their pain point is, how much they might pay for it, even if they are still trying to pilot it or get access to it initially, that's helpful.
Okay. Kira, what about you guys? Same way, or do you look at things a little bit differently?
Yeah, we would look at those things. We tend to invest in a lot of companies that actually don't have any revenues, especially in the life science space. There are companies in the life science space that are going to exit without ever having revenues, potentially. So it doesn't necessarily need to be that you have revenues. I think in that situation, we're really looking at IP and that you have something that is of value in that. Because if you have issued IP and you have, say it's a therapeutic or a drug that has, made it past certain levels of trials, whether that's in animals or whatever it might be, and it seems to be working, that to us shows that there's a value in your company. So that's in the healthcare space. I think, showing that there's a large market for what you're doing, maybe pulling comps from other types of products that are addressing similar issues. So we've invested in fertility companies, and one of them had done, an Indiegogo campaign. So Indiegogo, Kickstarter, those are good ways to prove that you have some sort of, desire for your product without maybe even having your product ready to sell yet. That's one way you can do it. But just looking at the broader market and saying, look, there's people who are willing to pay $200 for a device that monitors, when they should be trying to get pregnant. And that company is valued at XYZ. That gives us kind of a ballpark for where you might be falling. So I think that's an important thing to do as well. Is, you may have a completely innovative product that's new, but you're still probably addressing some sort of problem that currently exists. So finding that market and showing us that there's consumers out there who have a desire for the market that you are addressing is an important one as well.
And what about, so Dom, I'm going to parlay into my next question, which is about valuations. Okay. Valuations are all across the board. I know I've had multiple conversations with lots of folks in regards to valuations where I think that they're crazy at what they're valuating their companies, especially in digital health. I'll say that because usually you're pre-revenue, you have an idea, but there's really nothing other than the IP that has, quantifiable value, I guess you could say. Donna, when you were going through this process with your company, how did you determine valuation, or what aspects, I don't want you to go into the whole calculation, but what aspects did you look at in regards to establishing the valuation? So when you went out to raise, it was reasonable for your organization as well as the investor.
I personally think, and granted, taking like IP out of the equation when there are some clearer markers for valuation. When we're talking about early stage companies, which I'm assuming everybody here is, when revenue, you can't use that as a multiplier to come up with. It is honestly kind of demand and supply. I think that is the biggest, if we're being really honest here, it's the biggest determination of valuation, right? Yes, you can talk about your team having expertise and you can talk about how big the opportunity is and yada, yada, yada. Ultimately, if you want to have real kind of bargaining power over your valuation, find other people that are interested. And beyond that, that's what ultimately is going to drive your valuation up or down. If you really need money and there's only one person interested, then they're going to drive the valuation. That's just how any negotiation works. We had somewhat of an advantage as well, because we went through, for example, Techstars, or if you go through YC, you have a really clear idea of okay, in my class and all of the previous classes, right? These 25 companies raised this much money at this valuation. You can use those things as a benchmark, but I think ultimately at the stage that you're in right now, not having real clear mathematical equations to come to evaluation, I think honestly, it's just demand and supply. But that's my perspective.
That's fair. And so I'll open that question up to Karen and Kara. So, and then I want to also ask, are there terms that you won't do? Are there certain vehicles, convertible notes, safes? I mean, are there other components that you wouldn't look at? You know, you talked about the business model or the terms. You know, are there, you know, for the entrepreneurs, are there things that you don't really look at, you think are egregious to the valuation? I mean, talk a little bit about what you guys think. Karen, we'll start with you. What do you think in regards to valuations, and what are you looking at?
You know, valuation without terms is meaningless, actually. Actually, I had a guy that I worked for who would say, your price, my terms. But I do try to have a rational price in simple terms, because if you have complex terms, those things tend to show up down the line. So I try to keep the terms simple. You know, I think Dom is correct that, you know, early stage companies of an ilk, there's sort of the average valuation that they're getting. A lot of it depends on how much you need to raise, how much the early investors need to own, what, you know, if they're targeting a 20% ownership stake, and how much you need to raise is a function of, you know, what it's going to cost you to build it, and how far you're going to go, and is there an opportunity to still get that 10x. So you can model it and try, and that's typically how I approach it. You know, if I'm trying to get to a 15 or 20% ownership in an early stage company in a Series A, and how much are they raising, that's kind of how you get to it in my mind. But I think it is a function of supply and demand. I think that's exactly right. If somebody's willing to pay more, then you can get more, and that's how that works. You know, in terms of what terms, I'm usually driving terms. So, but I do try to keep them simple. I've certainly seen more, hey, I got to get a 2x on this lately, but I'm seeing some of that. If you can avoid those things and just have a lower price, but avoid that, I think that will inure to your benefit.
Kyra?
Yeah, I think the fundamentals of it is, if we look at your valuation and we think that, you know, we're looking for at least a 10x return, and we think that valuation times 10 doesn't make any sense for what your company is going to sell for off the bat, that just doesn't work. Ideally, we're looking for it to be even higher than that, because whatever you think your company is going to sell for, it may happen, and it may very well be less. So I think that's one way to do it at the beginning. And I think it's definitely a supply and demand. It's what other deals are we seeing, and where do you fall as far as being competitive in that. So we need to like your company, but we also want to like the value that we're getting and the amount that we're getting for the money that we're putting in. So I think that's a great point, that it's the supply and demand. And what we're seeing right now is that, you know, we want to see potentially lower valuations than what we have been, just because of the uncertainty that's going on right now. So I think that's a reality of it as well. And, you know, if people have already put money in a specific deal, if they've raised half of their deal, then we're looking at it and we're saying, okay, people seem to agree with this valuation. If they've been trying to raise money in a round for 3 months and they've raised almost none of it, then clearly that valuation is not something people agree with. I think to Dama's point, you can definitely look at other companies potentially in your space, or just what other companies are kind of getting right now. And that gives you an idea of what investors are probably seeing as well, and whether you're going to put out a valuation and they're going to think it's reasonable or completely unreasonable. We invest in convertible notes. We invest in equity rounds. We don't do safes.
Okay. And so in that regard, is there ever a time where when you invest in a company, in your pre-seed or Series A, will you reinvest in the next series? I mean, is that a typical thing that you do? I mean, obviously supporting that organization. So I always like to have investors, you know, that are with me that say, hey, look, if they hit these milestones, we're all willing to put more money in. Is that kind of the same mindset that you guys have when you're looking at opportunities?
100%.
Absolutely. Absolutely. I think when you're making early stage investments, you should be thinking about adequate reserves to go a couple of rounds.
Well, and that brings up another point. You know, co-founders, CEOs, they spend a lot of time raising funds. You know, and that time takes away from running their business. You know, I always tell people be very careful as to the amount that you're raising. Make sure that you need that money, you know, and you're not trying to oversubscribe, and it takes you more time, and then you're not growing your business. So again, there's a happy medium there in regards to what do you really need? How are you going to utilize those funds? You know, what are the milestones you're trying to hit with those funds? I mean, again, a very, you know, detailed strategic plan, I think, is very important for investors. I know that that's what we look at, and I'm sure you guys do as well, as to what are those milestones we have to hit. I don't want you to spend, you know, 3 months out of the year fundraising when you could be growing the business at the same time. So again, I think that's a happy medium that you have to kind of establish.
Yeah, I think that's a great point. And I think finding the right investors early on is a wonderful way to get ahead of that, because, you know, we want to invest in your next round. And that's one less person that you have to go find. So if you hit your milestones, we're there, we're taking your call, and we're trying to connect you with our network of people. And I think if you find investors who are willing to do that, it makes it a lot easier on you later on.
And I have to tell you, you made a great point. Picking the right investors. I know when we sold our company, or I sold my company, you know, there was a lot of opportunity in regards to who was going to be our partner moving forward. I tell people it's like a marriage. It's almost as important as a marriage. You know, pick your partners wisely, because those are folks that are going to be with you in the trenches, and they're going to follow you throughout the life cycle of your company. And so I think you're right. Picking the right partners is such an important decision. Don't make that lightly just because they have money. You know, again, what value do they bring to the table? How can they help you? Again, making sure that they're not calling you 15 times a day for the same thing and letting you run your organization. So I think it's very important to make sure that you do pick the right partners. So let's
I think that's fair, but I'll make one point though. While I don't think you should have like a protracted fundraise if you can avoid it,
True.
I actually think if there's within the realm of reasonable, if there's extra money around, if you say you were going to raise 10 and there's 12, I would take the 12. In this environment in particular, I would take the 12 and give myself the extra runway. And that's where you're seeing these funds. It's a great opportunity for venture funds that have money, because great companies are opening up because they want to make sure they get some extra runway. So it is a balancing act. Don't be protracted, because you do have to run your business, but sometimes you should sweep up some of those dollars that are on the table.
Fair enough. Fair enough. Well, guys, we only have about 8 minutes left, so I want to go into one of the questions, and I want to talk a little bit about takeaways from you guys. But let's just talk about the future, okay? Obviously, there's a lot of unknowns. We don't know what's going to happen in the next 6 months to a year. But what areas or what industries do you think are really going to flourish over the next 6 months to a year? Where do you see the bulk of the investment money is going to at this point? Did I stump anybody? Okay, Karen, go ahead.
That's interesting. You know, I do a lot of investing in industrial related topics. There's a lot of discussion around supply chain. I think you're going to see some reshoring of manufacturing and some need to build out some new supply chains. So that's interesting. I'm seeing a lot of opportunities around enhanced digital collaboration tools and sales tools, and I think that remains interesting. You know, certainly it's you know, when COVID struck, that was like a 101 in telehealth, and I think that trend is going to continue. So there are a lot of exciting opportunities in healthcare, as well as on the industrial side and the tech side, that I think are timely and that COVID is a tailwind for.
Kyra?
Yeah, I think in healthcare, I think telemedicine for sure. I think that remote monitoring of patients is something that's coming out of this that will continue, because there's people in rural communities where it's hard for them to get in and see their doctor. There's older individuals, for example, who are looking to age at home and not have to be in a facility, but may need more monitoring while they're at home by themselves. So I think that's a trend that's not going to stop. I think companies like Zoom, for example, I think Zoom has skyrocketed. It was something that so few people were using, and now no one doesn't know what Zoom is. So I think the trend towards being able to work remotely, being able to work on your own terms, in a way that makes sense for you, and not having to do business trips or going to an office. I think that's not going to change. I think people will probably go back to some version of normal, but I think that remote work is going to continue. And I think for startups, there's some benefits there, because you can get, you can pitch to angel networks across the United States without having to actually fly there. The cost savings are big in that sort of thing. I agree that complex supply chains, people are going to look at as a potential issue. And so bringing things back to the United States, when we're seeing companies right now that manufacture here in a very simple way, that is appealing right now, because we're seeing disruptions in supply chain with everything that's going on in the world. So I think that's going to definitely be a trend as well. I think, one example in the fitness space is you have Peloton and things like that are kind of coming into people's houses. So I think in different industries, that trend is probably going to continue. I don't think, in-person things are going to go away completely, because I think all of us are probably missing that right about now. So I think there's still going to be some of that, but the trend towards, being able to do your own schedule and do more from your house than you used to do is going to continue. And then an interesting one, I think, is that we're seeing is a lot more in the fertility space, because this is kind of put on hold a lot of people's ability to go into clinics and to go see doctors with that, and interrupted, IVF cycles and things like that. So I think that's a space that's going to continue to expand as well.
Perfect. So Donna, let's kind of wrap things up here. So I'd like to get your final thoughts, just some singular takeaway for the folks that have joined us today. So give us kind of some insight, or an insight that you'd like for them to take away from today's topics.
Yeah, I suppose the main thing that I always see founders really struggle with, like, ultimately time is your most valuable asset. Like, it really, really is. And it's about building momentum. And I think it's so easy to get distracted and get caught up with fundraising. So before you embark, because it is a time suck, like, it is not that easy to close a round. So I would say, before you embark on that journey, really think about and focus your time on, like, are you building a product that people want and that people need? And I think the more traction and evidence you can build around that, the easier it is to fundraise, right? Like, money can absolutely, you can reverse the script essentially, but you need to have a product that people want, and you need to have evidence that that's the case. So if I would spend my time, my valuable time right now, I would always try to over-index, if you can, doing that rather than spinning your wheels on fundraising. That would be my main takeaway.
Perfect. Karen, I'll go with Karen, you got 30 seconds.
Sure, I would say great companies are going to get formed now. I mean, stress focuses the mind. If you think about it, Shakespeare wrote his best works during the plague. Instagram, Uber, Pinterest, Square, Slack, they were all formed during the great financial crisis. So great companies will get made.
Kyra?
Yeah, I agree with that. I think that, as a founder, you're up against all kinds of unknowns, and now you're up against a really, really big unknown that no one could have predicted. But I think that it's a wonderful way as an investor to kind of stress test entrepreneurs and see how they problem solve in real time. So use that as an advantage for yourself to show your investors, what you really are capable of.
Fabulous. Well, panelists, thank you so much for joining us. For all the folks that are joining us today, there are 2 more series within Ignite's innovation webinars. Thank you to TMCX for being our partner in this series. Again, Aisha McCracken will be moderating our next one next week, I believe. So check that out on the website. We appreciate everybody being here. Thank you so much. And panelists, again, thank you for taking the time to talk to our entrepreneurs and investors.